Okay, y'all, welcome back. In this video, what I'm going to do is demonstrate a discounted cash flow model. Now, I'm not going to do that. Well, let me say that a different way. I've toyed with a couple of different options here. The reason being that a true model would literally showing you every step from scratch would be a huge undertaking, and a video that would be sort of prohibitively long. So I am hesitant to do that, mostly just because I'm not sure how interested you all are would be in, or would be in watching, a 3-4 hour video, even with something like this. So what I am going to do here, and I may do something more extensive later if anybody's interested. But what I'm going to do here is try to do a sort of simpler version of a model with a little bit less, with a little bit fewer steps. And what I want to do is to match up what I'm going to the model that I'm going to show you with the numbers that are in the slides. So if you've watched the lectures and you've gone through and you've seen our steps of the valuation process, you've also seen that there is a DCF model through that with the numbers computed sort of throughout the slides. In a normal time, when we were doing this in class, we would just work out this particular model in class as the second part of this session on Chapter 8. And so what I want to do here is just to recreate this for you guys. And again, we can, if anybody's interested, I can think about doing a sort of true model, a more complex one. But again, it's a significant time commitment there, both in terms of me doing it and in terms of you watching it. So I'm hesitant to do that to start. So that's what we're going to do. I'm going to show you all the steps, and we're going to walk through. We're going to recreate all the values here. We're going to recreate the valuation at the end. There is still some stuff that we haven't quite talked about. Again, for instance, forecasting cash flows and things like that, that we'll talk about in later chapters, that I will sort of show you where the steps get taken without going into too much detail about how the steps get taken, because we'll have more videos and more lectures on that kind of thing. So I just want to give you a sort of picture. Or maybe not a picture. I want to show you the mechanics of how we move through these steps, right? And so I want this model to be broken up into, or this video to sort of be broken up into these steps in general. So we'll start with part one, which is analyzing the historical performance of the firm. And where that really starts is pulling the historical documents, the data of the firm down. Okay. That always starts with a trip to the SEC website. The SEC is the Securities and Exchange Commission, and the Securities and Exchange Commission is the regulator in the U.S. that's in charge of public companies, and they're the record keeper for all public filings made by public companies. So that's sort of the distinction, of course, that between a public and a private company is that public companies have, by law, are required to provide their financial information to their investors. And they provide them to the SEC, and the SEC makes them available to anyone who's interested using this EDGAR system. And, of course, this is open to anybody. You just search for SEC EDGAR. You come to the Securities and Exchange Commission website. The EDGAR site is specifically what we're going to use to pull down the relevant data. Now we are going to be pulling down data for UPS, so we're going to search UPS. We can search for the name. Let me go back and show you that search. There's a couple different ways we can search. If we know the company is a very obvious one, we can just search for the company name. Here we can search for UPS. The documentation within the Securities and Exchange Commission is sorted by what's called CIK number, which is the identifier that the SEC provides to companies, and it's a unique identifier. So if for whatever reason we're having trouble finding the specific company, we can search by we can look up their CIK identifier and we can search by that. But with a company like UPS, we don't really have to. So we click in here, and what we can see is just a list of filings for the firm. Okay, and you can see over here on the left-hand side that the filings let me put it here. The filings are listed originally in order of the day they're filed. So you can see that the last thing that UPS filed was September 10th, so exactly a week ago. They filed an 8K, which is a specific type of filing. And again, this isn't a class on specifically on this kind of thing, but an 8K is a filing that companies have to do to report certain major company actions. What we're looking for is something called a 10K. The 10K is the annual report of the company. So this is going to list their annual filings. But you can see that there's lots of different kinds of filings over here on the left-hand side. There's a 10Q. This is the quarterly financial statement. It was filed August 4th. Another 8K, so another material item that they're required to report. Something called a 25 NSE, which is, again, way outside the scope of this class, but it's something that you have to file depending on some securities that you have. An 11K, this is the report of the company's retirement plan. So we may actually, in a true model, you may end up using this to, as you're looking through the company's financial statements, you may need information on their retirement plans. So you can see there's tons of 8Ks because this is just required for, a number of different company decisions. They have to file an 8K, updated statements, things like that. They have sort of proxy statements relating to different rules and regulations. So you can see that there's tons of them. But what we're looking for is the 10K. So the 10K is the annual report and its notes. And we're looking for the annual report. They filed their annual report February 20 of this year. So we're going to sort here by 10K so that we only have the 10K. We can get rid of all those previous reports. Now you can see that we have one report every year, approximately for all the way back to the year 2000. This is just because electronically this is all that's provided for us. Right, but we don't need that much data. In the slides, the data that's provided in the slides, the historical data is only 2011, 2012, and 2013. So that's all I'm going to pull down just so that we can, again, I just want to give you a glimpse of the process here. So we'll look for the 2011 report, right? And I'll select this documentation. So I go into the document. Notice that there's a lot of attachments here. There's the Form 10K itself. Then there's the amendment to the retirement plan. There's an amendment to the savings plan. There's incentive programs, a deferred compensation plan. There's a bunch of certifications. There's the consent, the sign-off from their auditors. There's subsidiary information that's provided that we may end up needing. And so all of this is in HTML format, meaning it's just it's in a format meant to be read on a website through a browser. So this is the 10K for the United Parcel Service in 2011. It's tons of legal. I would say 50 to 60% of this kind of document is just legalese. It's just stuff that the lawyers have to put in there. It has all kinds of things. So here's just a general overview of the business. And it says something like UPS is the world's largest package delivery company, right? Stuff that we don't necessarily need or or are interested in. There is going to be information sort of that we pull from all over the place. For instance, it says we deliver packages each business day for 1.1 million customers in over 220 countries. That's something that we might make use of later in our analysis, but it's not something that we are going to necessarily drag down to start. Again, in the next sentence it says in 2010 we delivered an average of 15.6 million pieces per day worldwide, or a total of almost 4 billion packages. And it gives us total revenue of 50 billion in the previous year. So again, that's all not useless information, but it's not something that we're immediately looking for. They give things like a general outlook, right? So they say mixed economic results in 2010 combined with improving economic forecasts lead us to believe that the following trends will continue to grow our business over the long term. They give some specific reasons why they think that these trends are going to cause them to grow. So economic recovery in the global economy, sovereign debt crisis from Europe in 2010 is going to be an area of concern. They're increasing their just-in-time inventory management, things like that. Right, so they talk about a little bit about their operations. They're just telling us about the company. They're giving us the things that they think we need, and there's lots of this. Right, they talk about things like government regulation. They talk about things like risk factors for the company. What are the general risk factors that might affect the company? And there's a ton of this. They will provide sort of more information than we could ever need, right? Like the first table we come to is the number of aircraft that they have, both owned and capital leases, and we'll talk about some of that here. So they own 216 different aircraft, things like that. Okay. Now, the first thing that we sort of come to that is at least recognizable to us in terms of financial statements is here, this selected financial data. Now, this isn't exactly what we want, but it is, you can see that it is a general picture of the income statement for the firm, and they provide it for 5 years, right? So this is pretty common for them to provide a small history within each annual report, and it's a way for us to check. So when we look at the 2012 report, we'll be able to check that none of these numbers have been amended or restated, because that's one of the things that you want to be careful about. Companies amend their financial statements all the time when government rules or regulations change, things like that. So we got to be careful that we are getting the most correct, up-to-date data. But you can see this is a revenue. And they've broken down their revenue by sector here. So U.S. domestic package, international package, supply chain and freight. There's total revenue minus expenses. So compensation and benefits, operating expenses. That gives us our operating profit. That's what they're calling EBITDA. Then they have some other income. They've got some income tax expense, net income, and then they've got dividends per share, things like that. So a very sort of simplified income statement is provided here. This is the first thing that we're looking at. In some sense, it's helpful to look at it and say, okay, UPS has profit here, net income of 3.4 billion, and that's grown from 2.1 billion in 2008. Of course, they had some really bad years in 2007 and 2008, and during the financial crisis. Right. They give you some selected balance sheet data. They're things that you might they think you might want to know just at a glance. Then there's a section that's actually really important that we'll sort of gloss over. But if you're really doing one of these, it's called the management discussion and analysis. Now there's a bunch of these sections spread throughout these documents, and this is where the management gets the chance to talk about the company in more candid terms than in just legal definitions. So these are really important for us to get a picture of what the firm is actually, or what the management is saying about what the firm is actually thinking, where they think they're going, what they think they're doing. So this isn't a huge section here. In other words, they're not talking about a ton, but they are talking about some different things. So just get a sense of how big these statements are. I mean, I'm scrolling through here. They're breaking down the margin by sector. So this is their U.S. domestic package operations, their international package operations, their supply chain and freight. Now they're breaking it down by the sort of most valuable sector. So we'll talk a little bit more about that when we get into more detail. This is a newish requirement by the SEC that they trying to give companies to give us more data. So instead of what's called the consolidated statement, they're giving us a separated statement by their most important sectors. But again, you can just see how huge this is, how much data this is to try to pull in and to try and condense into something that makes sense. Okay. Here's where we start to see the actual information that we're going to need, or at least the place where we start. So notice that here we're down on page 55 already, and we see what's called the consolidated balance sheets for UPS and their subsidiaries, the consolidated income statement for UPS and subsidiaries, the change in the income statement, the statement of consolidated cash flows, and then a bunch of footnotes to the consolidated financial statements, right? And the footnotes go on forever with additional tables. Footnote 4 for property, plant, and equipment breaks down what is contained in property, plant, and equipment for us in more detail. So like the last 50 pages of this statement are basically additional footnotes that turn this relatively small consolidated balance sheet into a significant endeavor. In other words, right, they list property, plant, and equipment net here, and they give us a total. It's $17 billion in 2010. But there's a table down lower, a note attached to this that's going to break down property, plant, and equipment so that we have a better idea of what makes that up. So how many trucks do they have? How many planes do they have? So if we go down to that footnote for PP&E, let's see if I can find it again. Marketable securities, impaired loans. Here's the property, plant, and equipment footnote. So they have a total of $17 billion in PP&E, but that's broken down into some amount of vehicles, $5 billion in vehicles, $14 billion in aircraft, $1 billion in land, $3 billion in buildings, $2 billion in building improvements. They've got plant equipment, they've got technology equipment. They have equipment under operating leases, which is something we'll talk about. Notice how huge that number is, $35 billion worth of equipment that they are leasing. They are renting instead of owning, and that keeps it off the balance sheet. Right? Notice that this 17 billion figure is not including this 35 billion in operating leases. Okay. Now some of the rules have changed. They are talking about some of this in some of these footnotes. So as we're moving through, one of the things that we're going to have to do is read through all these footnotes as we're collecting our historical data, so that we understand what all these footnotes are reporting. Right. So for instance, this footnote says, we continue to monitor our aircraft fleet utilization in terms of fuel prices and projected volumes. In 2008, we announced we were in negotiations with DHL to provide air transport for their DHL's international package delivery. They mutually agreed to terminate the discussions in 2009, so that thing fell apart. Their domestic package air delivery has declined for several quarters because of the crisis, presumably. So they're using less of their aircraft fleet. They're talking about different accounting terms, whether they have to impair, the value of certain aircraft, where they're reporting these charges, what the lease holding obligations are for them. So this can get fairly complicated fairly quickly as we try to understand what is actually contained in these consolidated statements. Okay, so that's why I want to try to stick with a slimmed down version of this model, because otherwise this video is going to get really long really fast. So the first thing that we're going to do, of course, is we're going to try to take down this data. Now, depending on what we have, we may just actually have to copy it from the HTML file. Some companies provide Excel spreadsheets of the data. It might be interactive data here. Yeah, so sometimes they provide Excel spreadsheets. Here it looks like they're just giving us a breakdown of the consolidated balance sheet, so that we don't have to say download the file. So here's the consolidated income statement, and this should be easier to copy for us, particularly into our. It looks like it also has all the notes here, so this will make it easier for us to pull out here's all the footnotes. So this is probably a significantly easier way, at least for UPS, to pull down all the relevant information. Here's all the additional tables. Yeah, this is going to be really nice for us. Yeah, lots of different data. Here's the income tax table, which we'll talk about in a later chapter. The reconciliation of the income tax table, all that stuff is in here. So what we do, and here I'm just going to I'll start a fresh Excel sheet here. We just want the text, and that copies relatively easily, right? So we have our 2010, let's get rid of the 2009, we got the balance sheet in millions, let's put that up here. We can clean this up a little bit. I always like to try and clean it up so that it looks more like a balance sheet. And so here's the data for 2009, 2010, right? We know that that's not all the data we need, but this is the place where we start, right? Certainly we know there's more information to be had. For instance, I could break property, plant, and equipment, and I could come over here to PP&E and I could break property, plant, and equipment into this additional table, right? I like to keep the original consolidated financial statements consolidated to start. The reason they're consolidated to begin with is just because it's cleaner, right? So this is already 50 lines. If I start to add in all the additional detail from all the additional tables, we'll have, several hundred lines of balance sheet here, and it gets a little wonky sometimes. And we don't necessarily need all that additional information right off the bat. So what I like to do first is just take the consolidated financial statements, just the historical data, and lay it out. So what we do here, right, this is our 2010 data, or 2011 data, then we'd go get our 2012 data. Right, and notice here it has 2011 and 2010. So we could check that our 2010 data here hasn't been amended, and so that it matched up here. So now notice here another thing. Right, let's look at the difference between these two documents. So where's the consolidated balance sheet? So we have cash, marketable securities, account receivable net, finance receivable net, deferred income tax asset, income tax receivable, other current asset, total current asset. Whereas here we are missing finance receivable net. So we are missing some items. So it's not, there is not always a standard right? Structure, well, I guess we can make that a stronger statement. There is not a standard structure for a balance sheet or an income statement beyond the sort of bolded items, right? Current assets, current liabilities, total assets, total liabilities, shareholders' equity, owner's equity. Those are standardized. The items that make up the rest of the balance sheet and income statement are not standardized. And they're not even standardized within firm, right? So notice that they're reporting finance receivables here. They're not reporting it in the 2012 statement. If I had to bet, that's what I'd say they did instead. Actually, let's see, 712 plus their finance receivables, 230 million. Their income tax receivable, 287, 1202. Yeah. So this is one of the worst. This is one of the worst parts about a process like this. So notice what they did. They had all these items here. They had broken down finance receivables. They had broken down income tax receivables. So these are specific types of receivables. An income tax receivable is money that the government owes UPS because of some tax restatement. They paid too much in tax, so they get money back. A finance receivable is similar. They've made some kind of financing extended loan that's not accounts receivable to somebody, and they're reporting it here in their 2011 balance sheet for 2010 and 2009. When they file the 2012 balance sheet, they no longer report those two items in their consolidated balance sheet. Instead, they combine it into other current assets, right? So they make their statement smaller. So they restate the 2010 statement, which is right here, 2010. They restate it. So notice that the other current assets in 2010 here is 1,202 million. In 2010 here, it's 712 million. And what they did was they added the finance receivable and income tax receivable. And that's how they shrunk this balance sheet. So there's probably a couple other places that they've done this here. It looks like they just decided to stop reporting finance receivables as an item on the consolidated balance sheet. So they're probably adding it here into other non-current assets here. I'm almost sure that's what they're doing. And so that's why these aren't matching up. So even before we're like actually getting into doing anything, the first thing we're doing is looking at these financial statements and trying to make them comparable and understanding why they're not, right? So this is why it's really helpful that they report these previous years so that we have something to compare to, so that we know how the changes got made. And that's specifically why they report these previous years, because when they change their restatement for the 2011 data year, they show us how that restatement changed the 2010 data year. And then what we have to make a decision as analysts is whether we want to consolidate our historical data sheet down and get rid of these and just combine it into current assets just like they did. Okay, so the decisions we got to make. I'm not going to show you all of that again. You've got the gist, I hope, of what we're doing. We're pulling down then we'll do the same thing for the consolidated income statement, and ultimately what we're looking for is the consolidated income statement for 2011, 2012, and 2013, and the consolidated balance sheet for 2011, 2012, and 2013. Right. So notice that we make some changes here, specifically combine all that into current assets and things like that. Okay. So we're pulling down all this data. We are making sure that we're tracking the information correctly. And we would normally be pulling down this kind of data for like 10 years. Again, the examples that are in the slides are only for 3 years, so I just want to stick with that, and that way we don't get bogged down in a bunch of minutia.